The Chinese equity market has underperformed in the first half of 2026, overshadowed by the strength in AI chip rally in Taiwan and South Korea. But entering the second half, the offshore market in Hong Kong has made a decent comeback, with the Hang Seng China Enterprise Index up 14% so far, and the MSCI China up 11% since the start of the third quarter. The question is, what could be the catalysts for Chinese equities in the coming months? What should APAC investors do when it comes to including China into their portfolio construction? Hi, welcome to On Investors' Minds. I'm Tai Hui, the Chief Market Strategist for Asia Pacific at JP Morgan Asset Management. And thank you for giving us a few minutes of your time to understand what investors are thinking right now and how that fits in with building the right portfolio. So today we want to discuss China, and we'll do this in three parts. The first part will discuss some of the more recent economic data and what is that pointing towards. Secondly, what are the policy directions from Beijing, especially after the July politburo meeting? And thirdly, what does that mean for investors? The investment case for Chinese equities over the short, medium, and longer term, and where are the opportunities? So let's start with the macroeconomic data. So the Chinese economy expanded by 4.3% year-on-year in real terms in the second quarter of 2026, down from 5% in the first quarter. Now that averages around 4.7% for the first half, which is still broadly within the government's 4.5% to 5% growth target for this year. But here's the key. The composition matters more than the headline. There is still a divergence in the growth driver within the Chinese economy. Some people call this the two-speed economy or the K-shaped economy. But what does that really mean is that the export sector and high-tech manufacturing continues to hold up better, while domestic demand in the property market continues to be a constraint on growth. More recently, the new data points, for example, the July PMI data, continues to soften. The official NBS manufacturing PMI data fell to 49.2 in July, back below the 50% threshold that separates expansion from contraction. It wasn't just a headline. New orders slipped to 48.5, and new export orders also edged down to 49.6. And it wasn't limited to manufacturing either. Non-manufacturing PMI or service PMI dropped to 49, where the composite PMI output index stood at 49.3, again below that 50 threshold that indicates expansion or contraction. But the good news is that the export engine continues to move along. The July data was still strong. Exports rose 24% year-on-year in July, while imports rose 27.5%. This is brought by a surge in AI-related demand, think semiconductors and batteries, and also strong shipments of cars. So a clean way to look at this is that the July trade data confirmed the real resilience in the export sector, but the July PMI data is a reminder that demand, especially domestic demand, continues to be fragile, and momentum can wobble even as the medium-term transformation story of the Chinese manufacturing sector remains intact. So what about the policymakers? What are they thinking? What are they planning to do? So in the July politburo meeting, I think there are some important messages. First, proactive fiscal support remains in place, accommodative monetary policy, and also incremental property stabilization measures are still very much on top of their minds. And of course, the continued emphasis on artificial intelligence, advanced manufacturing, and also private sector developments. So overall, policy is still pro-growth, but increasingly focused on efficient allocation rather than just a bazooka approach when it comes to spending and loosening monetary policy. The good news is we still see ample fiscal room for stimulus if required. Up to May 2026, the central and local government bond issuance was only 5.7 trillion yuan out of 15.7 trillion yuan quota for 2026, or just 1/3 of the annual quota, which implies that more fiscal support could be deployed later in the year if the central or local governments choose to do so. So what does that mean for investors? What's the investment case for Chinese equities from here on? I think there are two dimensions to this. The first dimension is the structural layer, policy-driven industrial upgrading. Now, the 15th five-year plan has emphasized a shift towards self-sufficiency when it comes to economic organization. So, for example, self-sufficiency in core technologies, supply chain resilience, and strategic buffers, really mapping directly into AI, robotics, automation, semiconductors, and critical minerals. Over time, that kind of structural push can broaden earnings potential beyond a narrow set of winners. And then we've got a cyclical layer, the next 12 to 18 months, where we have export industry doing very well, but domestic demand continues to be in a more difficult spot. Here, the macroeconomic data is still showing a two-speed economy, as we mentioned earlier on, with strong exports and weak domestic demand. Export competitiveness and advanced manufacturing can be resilient, but consumer confidence, property stabilization, and also domestic demand impulse still matter a lot for the broad-based equity upside. Now, this could be driven by government fiscal policy, and we've seen in the past fiscal policy supporting particular sectors in consumption has yielded short-term results. And meanwhile, Beijing has ample room to accelerate fiscal spending later in this year if it chooses to. Now, this additional boost could provide a more comprehensive growth momentum needed to boost sentiment amongst investors. So the bottom line is we still see Chinese equities playing a key role in investors' portfolio construction. Technology, policy tailwinds could still support specific industries in the short term, as we've seen in the recent months. Especially hardware and AI model developers, this required active company selection. Additional catalysts could come if the government decides to step up on fiscal support to boost growth in coming months, and this could allow for a more comprehensive improvement in earnings expectations. As we've seen in recent years, these catalysts could come hard and fast and require investors to be positioned already into the Chinese market instead of jumping in as the rally approaches. And hence, the best way to do this will be A, active selection, picking the right companies that feeds into the policy direction, and B, stay invested in Chinese equities in order to maximize the benefits when these catalysts do arrive. Now, thanks for listening. If you enjoyed this podcast, please share this with your friends and colleagues, and of course, consider subscribing. If you have any questions for us, please reach out to your JP Morgan Asset Management client advisors. I'm Tai Hui. I'll see you next time to discuss what's on the investors' minds. And meanwhile, stay informed and stay invested.
This content is a general communication being provided for informational purposes only. It is educational in nature and not designed to be taken as advice or a recommendation for any specific investment product, strategy, plan, feature, or other purpose in any jurisdiction, nor is it a commitment from JP Morgan Asset Management or any of its subsidiaries to participate in any of the transactions mentioned herein. Any examples used are generic, hypothetical, and for illustration purposes only. This material does not contain sufficient information to support an investment decision, and it should not be relied upon by you in evaluating the merits of investing in any securities or products. In addition, users should make an independent assessment of the legal, regulatory, tax, credit, and accounting implications and determine, together with their own financial professional, if any investment mentioned herein is believed to be appropriate to their personal goals. Investors should ensure that they obtain all available relevant information before making any investment. Any forecasts, figures, opinions, or investment techniques and strategies set out are for information purposes only based on certain assumptions and current market conditions, and are subject to change without prior notice. All information presented herein is considered to be accurate at the time of production, but no warranty of accuracy is given and no liability in respect of any error or omission is accepted. It should be noted that investment involves risks. The value of investments and the income from them may fluctuate in accordance with market conditions and taxation agreements, and investors may not get back the full amount invested. Both past performance and yields are not reliable indicators of current and future results. JP Morgan Asset Management is the brand for the asset management business of JP Morgan Chase & Company and its affiliates worldwide.